Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate world. And today we're diving into the Boston Beer Company's latest quarterly report, and let me tell you, they've had a pretty interesting quarter, especially with some big names in their portfolio doing well. Let's just say things are shifting. Make sure you subscribe because we break down these filings so you don't have to, and join our Discord community linked in the description below to keep the conversation going. Alright, so this is the company's quarterly report, a 10Q, covering their period ending the 27th of September 2025. It's essentially a check-in on how they are doing right now, financially speaking. The Boston Beer Company, the folks behind Samuel Adams, Twisted Tea, Truly Hard Seltzer, and Angry Orchard, are giving us the inside scoop on their performance. Let's jump straight into the numbers. Looking at their balance sheet as of the 27th of September 2025, the company has total assets of over $1.2 billion. Now that's a lot of assets, but compared to the end of the previous year, the 28th of December 2024, it's actually a slight decrease overall, down from about $1.25 billion. On the flip side, their accounts payable, meaning what they owe to others, went up slightly to about $102 million from $87 million. That's a common thing for businesses, just means they might be holding onto their cash a bit longer to use for other things. One notable item is their property, plant, and equipment, which is a big chunk of their assets. It dropped from over $616 million down to about $580 million. This could mean they sold off some assets or perhaps accounted for depreciation, which is like saying assets lose value over time as they are used. Now, let's look at how the company is funded. Their additional paid-in capital, which is basically the money shareholders paid above the stock's face value, increased from around $676 million to over $690 million. This suggests they either issued more stock or retained more earnings, which is generally a good sign. However, their retained earnings, which represents the accumulated profits that have not been distributed to shareholders as dividends, actually decreased from about $240 million to just over $220 million. This is something to keep an eye on. It could mean they are reinvesting a lot into the business. Or it might suggest profits aren't as strong as they once were. So while they have more shareholder capital, less of it is from historical profits. Moving over to their performance over the last 3 months, ending the 27th of September 2025, they reported net revenue of over $537 million. That is down by about 11.2% compared to the same period last year when they brought in over $605 million. This drop is a big deal. The company itself points to decreased sales volume as the main culprit, impacting sales by around $83 million. And this decline in sales volume is clearly seen everywhere. They sold about 13.7% fewer barrels of their beverages, going from over 2.2 million barrels down to just over 1.9 million barrels. That is a significant drop in sheer volume. But here is an interesting twist. Even though they sold less, their net revenue per barrel actually went up by 2.8%, reaching over $277 from about $270. So they're charging more for each barrel they sell. This is likely their strategy to offset the lower volumes. Now, let's look at what it cost them to make these beverages. Their cost of goods sold per barrel decreased by almost 6%, going from about $145 down to just over $136. This is good news for them. They attribute this to things like renegotiating contracts, improving how they make their products, and lower third-party production costs. However, they also note that inflationary impacts like tariffs added about $6.20 per barrel to their costs. So while they're getting better at managing production, the rising costs of raw materials, especially due to tariffs, are still a headache, because the cost of goods sold went down more than the net revenue. Per barrel went up their gross profit. Per barrel actually increased significantly. It went up by over 12% from about $125 per barrel to over $141 per barrel. This is a positive sign showing they are becoming more efficient in their production. But here is where a big chunk of that gross profit probably goes: advertising, promotional, and selling expenses. These costs jumped by over 11%, reaching almost $165 million for the quarter. This increase is mainly because they are spending more on advertising and local marketing to try and boost sales. This spending now makes up a larger portion of their revenue at nearly 31% compared to about 24% last year. That means for every dollar they make in revenue, a bigger slice is going back into promoting their products. A very significant item from the prior year, which thankfully is not present this time, was an impairment of intangible assets. Last year they had a non-cash charge of over $42 million, mostly related to the Dogfish Head brand. This means they felt the value of that brand had significantly decreased. It's good they're not reporting that this year. suggesting they think the brand's value has stabilized or improved. All these factors combined led to operating income of about $62 million, a solid increase of over 35% from about $46 million in the same quarter last year. Even with lower sales volume, they managed to make more money from their core operations. Much of this improvement comes from that lower cost of goods sold per barrel and the absence of that big impairment charge from last year. Their income tax provision was higher this quarter at nearly $18 million compared to about $15.6 million last year. This led to an effective tax rate of about 28%, down from nearly 32% last year. They say the main reason for the lower rate is less non-deductible stock compensation expense, which is a win for their bottom line. So after all that, their net income for the quarter was over $46 million, up significantly by about 37% from just over $33 million last year. This shows that despite selling less, they were more profitable this quarter. Now, let's zoom out and look at the longer 9-month period ending the 27th of September 2025. Net revenue was over $1.57 billion. This is a slight decrease of about 1.9% compared to the same period last year, bringing in just over $1.61 billion. Again, they're pointing to lower sales volume as the primary reason, but they were able to offset some of that with increased pricing and a better product mix. Total volume sold for the 9 months dropped by 3.7% from nearly 6 million barrels to just over 5.7 million barrels. This decline in volume seems to be driven by brands like Twisted Tea and Truly Hard Seltzer, with some growth from their Sunday Cruiser brand. Their net revenue per barrel increased by 1.8% to over $273. So, similar to the quarterly trend, they are managing to get more money for each barrel sold, helping to cushion the blow of lower volumes. The cost of goods sold per barrel also saw a decrease of about 6% from over $146 down to about $137. This is thanks to contract renegotiations, recipe optimization, better brewery efficiency, and lower third-party production costs. However, inflation and tariffs still added a significant cost, almost $4.6 per barrel. This led to a more substantial increase in gross profit per barrel, up by over 11% from about $122 to over $135. This is a strong improvement in their core profitability. Scroll advertising, promotional, and selling expenses span. It's important to note that while their gross profit is looking better, their advertising, promotional and selling expenses have surged significantly over the 9-month period, increasing by nearly 12% to over $461 million. This means they are pouring a lot more money into marketing and sales effort. These expenses now represent a much larger portion of their net revenue, about 29.3% compared to 25.6% last year. This rise in per barrel spending is directly linked to their lower sales volume and increased marketing investments. Again, the significant impairment of intangible assets, that over $42 million charge from last year related to Dogfish Head, is not present this year. This absence contributes to the improved operating income and net income for the current period. Their effective tax rate for the 9 months was about 28.8%, down from 30.3% last year, mainly due to those lower non-deductible stock compensation expenses. As a result of all these changes, their net income for the 9-month period showed a very strong increase of over 33%, going from about $98 million to $131 million. Despite selling slightly less, they've managed to greatly improve their profitability, largely thanks to better production efficiency, higher prices, and the absence of a major past charge. Now, let's talk about cash. Their cash and cash equivalents have grown from about $211 million at the end of last year to over $250 million. This increase is mainly because of the cash they generated from their operations, even though they spent a good chunk of it on buying back their own stock and on capital expenditures. Speaking of stock buybacks, they spent a considerable amount on repurchasing their Class A common stock, over $154 million in the last 9 months of 2025, compared to over $177 million in the same period of the prior year. This is a common strategy used by companies to return value to shareholders and can sometimes signal confidence in the company's future. It's worth noting their stock-based compensation expense, which is the cost of paying employees with stock options or restricted stock. This was about $14.4 million for the 9 months this year, very similar to the $14.7 million from last year. Looking at their equity, specifically restricted stock units that have not yet vested, there were over 229,000 shares outstanding as of late September 2025. This shows a commitment to their employees, with a significant portion of these shares tied to performance or service milestones. Now, a bit of a legal situation. The company is involved in a dispute with Ardac Metal Packaging related to minimum purchase volumes of aluminum beverage cans. This case has been going back and forth, with recent court decisions attempting to clarify liability issues. The potential outcome could range from nothing to over $300 million. The company is fighting this vigorously, and it's a significant risk to watch. On the intellectual property front, they've been amortizing their intangible assets like trademarks. The amortization expense for the 9 months was about $1.2 million. They don't expect any future impairments related to the Dogfish Head brand, as they are now amortizing other intangible assets over a set period. When it comes to future obligations, they have about $216 million in commitments for things like brand support, ingredients, and equipment. A significant chunk of this, over $100 million, is expected to be paid out in the next few months of 2025. A major point of discussion as of October 2025 relates to tariffs. The company anticipates these tariffs will increase their costs for ingredients, packaging, and other supplies by an estimated $9 to $13 million this year, potentially impacting earnings per diluted share by 60 to 80 cents. They are actively trying to manage these costs, but it's a significant headwind. Alright, let's talk about what all this means for the Boston Beer Company. On the positive side, they've demonstrated impressive cost control in their production, leading to higher gross profit per barrel. They're also effectively raising prices to counter lower sales volumes. And the absence of those massive impairment charges from last year is a huge relief. This has resulted in a very strong increase in net income. However, the significant drop in sales volume across key brands like Truly and Twisted Tea is a clear concern. While they are spending more on advertising to combat this, it is a double-edged sword. Increasing expenses, the ongoing tariff situation also adds cost pressures that are difficult to fully mitigate. The supplier dispute with Ardac also remains a serious cloud hanging over them, with a potentially very large financial impact. In essence, Boston Beer is navigating choppy waters. They are becoming more efficient and charging more, which is boosting their profitability, but they are losing ground in terms of sheer volume sold, which is a fundamental measure of market share. The big question is whether their increased marketing spending will reignite sales growth or just become a bigger drain on profits. The company is showing resilience in managing costs and pricing, but the declining volume is a trend investors will be watching very closely. If they can't reverse that volume trend, even improved efficiency might not be enough in the long run. Alright, that is our breakdown of the Boston Beer Company's Q3 2025-10. Q, what are your thoughts on these numbers and what they signal for the company's future? Drop your insights in the comments below. If you found this analysis valuable, hit that like button, it really helps us out, and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching, see you next time.